Welcome back. You're watching The Firm and we're coming to you from Davos, the location of the World Economic Forum's annual meeting. As the global economy slows, every country present here is fighting harder to attract foreign investment. We just spoke of the model BIT in the previous segment. Now let's talk about tax. Enough has been said and done about the tax complications that foreign investors face in India. Well, the Easwar Committee just 3 months ago took on the task of simplifying India's very old tax code. Will their recommendations lead to a simplified tax regime in India? Let's find out.
The way I see the Easwar Committee report, there have been several committees which have been formed by the government from time to time to look at simplification of tax laws to provide clarity. Probably this is one committee which has given a set of suggestions which are so practical and so radical and down to earth that if indeed implemented in the forthcoming budget, this could really change the way the tax office and the SSEs are interacting with each other.
They've really come up with a good list of measures which I think address 3-4 key areas. One is bringing about a simplicity in the tax regime. The other is addressing the aspect of tax litigation, which has been extremely protracted and widespread in the Indian tax regime system. The other is trying to build a sense of accountability, trying to build that trust and confidence, and so to say making a case for building a larger tax base, building the trust and confidence amongst taxpayers and the tax collectors. And finally, I would feel that all of this has tried to be done both from a legislative standpoint and from an administrative standpoint.
I think the committee has made a very good recommendation in terms of saying that when Ind AS, for example, is being introduced, the committee has recognized the fact that too many changes are happening, too many things are besieging corporate India. So, for example, Companies Act, GST, Ind AS, ICDS. So, they have said for Ind AS, for example, let status quo be maintained and let tax not get into this. So I think that's a very far-reaching one. The second is the deferment of what is called ICDS, which is Income Computation and Disclosure Standards, against which there is a significant amount of opposition because a lot of it is timing differences and can significantly interfere with the way companies account for things, at least in terms of tax, and I don't think there's any need for anything like an ICDS. So they have suggested deferment. So these are two macro ones in a manner of speaking. On the substantive one, they have given or made recommendations on how to deal with capital gains versus business income, and essentially they have said that anything which is more than 1 year old, 1 year holding should be capital gains.
The committee has also made several procedural recommendations to improve the ease of doing business in India by bringing down litigation and reducing the compliance burden on businesses in the country.
Again, something which is an ongoing litigation day-to-day issue with the taxpayers face as to whether the income which has arisen is business income or capital gains. And two recommendations here, that if your income is less than 5 lakhs of rupees, if you have returned capital gains, it will be accepted without any question. Otherwise, even if the income is more than 5 lakhs of rupees, but the shares are held, say, for a period of 1 year and are reflected in the books of accounts as a capital asset, that will be accepted and not be challenged at all. Again, sort of killing off litigation.
The report talks of addressing most of the concerns under Section 14A, which really addresses most of the litigation that arises today under that provision. So if we look at the kind of Rule 8D litigation that presently is in vogue, it is phenomenal. And just addressing some of this will significantly bring down litigation, which has advantages both for the taxpayer as well as the tax administration and the tax collector. So we are told, for example, that if the dividend distribution tax has already been paid by the company, it is economically is as good as the shareholder paying the tax, and therefore the question of disallowing expenses to the shareholder for incurring the expenses in connection with the dividends that he earns or the shares that he has acquired should not arise, and therefore that disallowance should not take place. In most cases, if the investment is for holding shares, for example, and this disallowance is removed, it could result in significantly reduced litigation for both the taxpayer and the tax revenue authorities.
This committee has said that the communications to and from the income tax department electronically should be recognized. Now, it may not seem on the face of it to be earth-shaking, but I think it's a very important procedural suggestion which will significantly enhance ease of doing business, or at least reduce the unease of doing business. So that's number one. Large number of suggestions have been made, recommendations have been made in relation to TDS, both in terms of rates, in terms of enhancement of limit, and indeed in terms of the compliance burden on corporates or any tax deductor. So I mean, remember that somebody who is deducting tax in a sense is acting as, so to speak, for the government, and to put so much compliance burden is perhaps unfair. So that has been done. Quite a few of the things have been done on stay of demand, recovery, a lot of these things which make it very difficult to do business. And some of these suggestions are very practical, and many of these suggestions have been made in terms of point of time of issuing refunds, etc. So I think all in all, several suggestions on the procedural front to facilitate ease of doing business.
Experts say the committee might come out with more substantive recommendations in the weeks and months to come. But it is expected also that some of these recommendations already made by the Easwar panel will find their place in the union budget that's barely a month away.
Today, a taxpayer, a foreign non-resident taxpayer, does not get credit for the dividend underlying distribution taxes paid by the Indian company in the foreign country, because the foreign country regards dividends as being exempt for tax. So a specific provision to clarify that although a dividend distribution tax is paid by the company, it is paid for and on behalf of the recipient. Something which would be necessary to get credit overseas. So a number of such provisions which have been indeed recommended, and in fact in my interaction with many of the committee members, I believe they are very cognizant of this. They simply wanted to address the low-hanging fruits at this point of time and then come up with substantive recommendations later on.
One is, if the committee can deal with the architecture of dispute resolution and things around that, that would be very useful. So for example, dispute mitigation by, let's say, the government issuing position papers. So if the committee could make a recommendation on that and suggest to the government a mechanism to facilitate taking calls, that would be a very, very big step. That's one. On the substantive side, quite a few things could be done. So for example, we don't have a concept called group taxation. We could look at that, because companies may in many cases need subsidiaries for regulatory reasons like financial service companies, or for commercial reasons like infrastructure companies. So if the concept of group taxation can be introduced, it would lead to simplification.
This committee is a very broad-based committee. It comprises of revenue officials, it comprises of professionals, it comprises of retired or was chaired by the retired High Court judge. So all the factions have really put in their thoughts together. And I would be very, very surprised if almost bulk of the recommendations do not get implemented in the budget. My expectation is this budget, the changes will be modeled around many of the recommendations which have been given by the committee.
The Easwar panel has actually given the drafts of the provisions, which will significantly facilitate incorporating them in the budget. Virtually every provision that they have recommended or every suggestion that they have made is backed up by a draft of a legislation, which is very interesting and very welcome. So I think a lot of these suggestions, even though the time is short, the way the suggestions have been laid out, or the way the recommendations have been laid out, and the fact, as I said, that the draft is available, I am hoping that many of these suggestions will actually find a place in the budget.
Well, on that note, we're going to have to wrap it up here on this special edition of The Firm, coming to you from Davos, which is where the World Economic Forum's annual meeting was being held through the week. I'll be back in India next week. See you then.
The Firm, India's only show on corporate law, tax and audit matters.